How will we power our future? Can we create a healthy and clean economy? Climate One at the Commonwealth Club is at the forefront of the global debate about energy, economy, and the environment. Bringing together the brightest and most provocative leaders of our time, Climate One is the place where big ideas get heard. With thoughtful and insightful discussions on policy, business, science, and culture, Climate One founder Greg Dalton gets to the heart of the matter. It's our future. It's time to come together.
Today, we explore the connection between the economy, COVID-19, and climate with three experts. Kathleen Day is finance lecturer at the Johns Hopkins University and author of the recent book, Broken Bargain: Banks, Bailouts, and the Struggle to Tame Wall Street. Amy Jaffe is director of the program on energy security and climate change at the Council on Foreign Relations in New York. And Matt Rogers is senior partner at McKinsey Company and co-author of the recent report, Addressing Climate in a Post-Pandemic World. And later in the show, does divesting from fossil fuel companies have an impact, or is it just a symbolic gesture? Can individuals use their nest eggs to help finance a green economy? All this and more today on Climate One. Kathleen Day, let's begin with a historic look. You have studied many economic crises over the 20th and 21st century. How does this crisis, the unemployment rate, how does this compare to other economic disasters that we've seen?
Unfortunately, the numbers of this crisis compared to the Depression of the 1930s, even though the causes of this are very different and very different than every economic crisis is unique, but it also shares some components. One, of course, is it usually engenders some unemployment. So unemployment during the 1930s reached 25%. Now, remember, they didn't keep numbers as well as we do now, but still 25% is what people accept now. And now the crisis of 2009 to 2012 was about 10% around the country, average, even though some pockets got into the teens. We are already into the teens. In the last 3 weeks, up to 17 million people lost their jobs. And I've heard estimates from 13 to 15%. Some people think that's undercounting, and some estimates say it will exceed the 25%. But at any rate, it's a lot, and it's swift and big. And that's what is remarkable about it.
Amy Jaffe, you're an economic modeler. It went down fast. People are hoping it can come back fast also. Do we know what the shape, the V shape or all these other shapes out there about when we're going to come back and how fast? Do we know?
Well, I like to have two historical references that come from the oil market, and I think they're both important. After September 11, Americans inside the United States stopped flying for a period of time, and actually, we did not go back to normal domestic travel until 2004. So that can give you an idea of the challenge that we faced getting people back out and circulating and in airplanes again, because this is actually probably less irrational than the way people felt after a terrorist attack, which is what are the chances you're going to have every week, a terrorist attack in the airport? That was very low probability. So the second one I like to tell is what happened after SARS in China. In China, SARS hit in the end of 2002, and Chinese citizens in Beijing and other big cities became afraid to use public transportation. And so car sales in 2003 in China were up 30%. So you do get these responses, and then they sort of lay themselves out over time. And it's not quite as, I think the downturn can be very sudden. And I think the recovery is more gradual than maybe people are thinking.
Matt Rogers, your view on McKinsey, sort of, how quickly we'll bounce back, or this going to be a slow, uncertain climb out? It seems like timeframes keep getting extended. We first thought this was weeks, and now it's months, and now we're hearing, well, maybe 18 months till there's a vaccine.
Yeah, we've laid out a series of scenarios with the McKinsey Global Institute that range from a restoration of the economy in Q2 of 2021 to Q4 of 2024. I mean, it depends really on how long we stay down, because we're down much, as Kathleen was talking about, we're down much further, I think, than anybody expected. And There are certain parts of the economy that are going to really struggle to come back. Amy hit on the oil markets as one of those examples.
Kathleen Day, what are some lessons from past crises in terms of what works pulling America out of a recession? Of course, it depends on what put it in the first place. But what are some lessons from history? Right?
Yeah, one thing is debt. And one of the lessons that we learned the hard way in the last crisis is that it wasn't that people needed more credit, they needed less debt. So the stimulus package now, if you give people a check, then they spend it, they don't need one check, they need a continuous source of income that with which they can use to pay their groceries and their rent. So I use this example of one of my local pizza places here in DC. The owners made a decision to close so that their employees could go on unemployment. That gives them a regular check. Those people will be better off than waiting for a $1,200 one-time stimulus. So many people in this country, this crisis would be bad no matter what economically, but it has served to expose some of the vulnerabilities of the economy anyway. And one of those is that we have such a large number of people living from check to check. So any economic dislocation reverberates many times more with that group than with people who can work from home and continue to get a paycheck.
Matt Rogers, you flew a lot shortly after 2001, 9/11, and got patted down, I don't know, 500 times in a year. Do you have a different view on how quickly flying will come back? Will people be comfortable sitting next to someone who is worried about every cough and sneeze on a plane?
Yeah, I fly every week of the year. After 9/11, I got patted down, at least 4 or 5 times a week. And I want to get on an airplane and know that the person sitting next to me is actually COVID free. And I think the question is, how do we certify that? We certified in 2001 through pat downs. How do we certify that in fact my traveling companion is safe to fly? And again, I'm doing 500,000 miles a year on a normal basis, and this is my 40th day on lockdown. Usually after the 40, after the 40 days, you usually get to go out again, and I don't see myself getting on an airplane very soon.
So, Amy, Jaffe, that has profound impacts for the airline industry and all the fuel that goes into it. We've already got too much airline fuel sitting around everywhere.
Well, not to be too technical, but one of the problems we face that I think a lot of the listeners might not be aware of, when you put crude oil through a refining process, you get each product. It's very hard to get only diesel fuel. We need to have e-commerce deliveries and not get the jet fuel or not get gasoline or marine fuel. So one of the problems we have, especially here in the United States, but also somewhat globally, but definitely here in the United States, is we're running out of places to put all this jet fuel that we don't need. And that can cause tremendous logistical problems because we need a certain amount of diesel fuel to move goods around. And if we run out of storage, it's going to be very challenging logistically to keep the fuel system humming. And so I do think that's something that companies have brought to the attention of the White House. There's some companies that are looking to put jet fuel on ships and just float the ships around. People are thinking about what kind of storage facilities players might have that could be cleaned out and used just for jet fuel. Because, we all saw the news reports about dairy farmers dumping their milk somewhere. But, you can't do anything like that with oil. There's no dumping it. So you either have to stop producing it, and then you have to worry about what kind of dislocations that is going to cause, as we need one part of the barrel, as we call it in the industry, and not another.
Well, a lot of climate people would say, given the carbon budget, we only have 10, or the McKinsey says maybe up to 20 years left of carbon to burn at current rates. Amy, Jaffe, why doesn't we leave that oil in the ground rather than trying to refine it and store it in different places? We need to keep some of that carbon in the ground if we're going to meet the Paris goals and stabilize the climate.
Well, we have a really unusual opportunity now to reevaluate when we need to transport ourselves and when we don't. And we have a tremendous opportunity. I mean, we're doing the show now, over video and taping, and we don't all have to be in the same studio with you. And we're now realizing that technology is pretty strong. So, but we're also social beings. So the question is really going to be, do we have the political will to make good choices about when we're going to use transportation fuel and when we're not? And I think I feel a little bit more optimistic because we have a lot of technology that can be thrown at this. We've got, automated vehicles coming. We've got, delivery robots and delivery drones. So the question is, how can we organize when we come out of the pandemic to be more carbon efficient? And we need to do that, and that will definitely keep oil under the ground. The question is, though, what do we do about the automobile system? We have 271 million vehicles on the road today in the United States, and only 1 million of them are electric. And the transition to go from having half of them be electric, as you know, from California, has had a tremendously difficult time getting the population, which is highly committed to doing something about climate change. It's still been virtually impossible to get people in electric cars. So the question is, how are we going to move that forward? How are we going to stay out of our automobiles, especially if people are afraid to use public transportation for a period of time? That is really the critical challenge. And to me, it's going to be a combination of increased use of digital. Maybe we don't all have to commute to the office every single day. Maybe we don't all have to commute to the office at 7 o'clock in the morning, causing tremendous traffic around the Bay Area. Maybe people could stagger when they go in for in-person meetings. So we have a lot of flexibility to work on this problem, but we must work on the problem from the demand side. When we work on the problem from just curtailing supply, all you do is create tremendous dislocation. We need to work on the problem from the demand side.
Matt Rogers, we have a question from YouTube. Can we take the mortal fear we have of COVID-19 with 3 billion people worldwide sheltering in place and bring this fear and action to the far larger long-term problem of our climate emergency? And another one from Catherine on YouTube. We've changed our behavior so fast around COVID. How can we apply that to climate? Matt Rogers.
Yeah. No, and I think that in the near term, we're all focused on defeating the virus, but business leaders are now beginning to figure out how do we come back. And our view is quite clearly that we can come back both cleaner and, importantly, more resilient. I think there's a set of important lessons learned for climate from this COVID tragedy, and because this is a physical shock to the system, much as climate is a physical shock to the system, and that kind of physical shock, unlike the financial shock, isn't just about rebuilding confidence. It's about rebuilding infrastructure and thinking differently about how we build infrastructure. It's a systematic problem. So you have a problem in one sector that infects another sector. So we see demand decline in the oil sector, and that leads to a price war. By the way, we're going to see demand decline over a long-term basis in the energy sectors as a result of the energy transition underway. And we have 50 years of supply. So 50 years of supply means declining demand. What do we get? We end up getting, we're more inclined to get price wars, and that ends up being part of the story. The other thing that I think is important is this is a non-linear. The pandemic is nonlinear and climate is nonlinear. We now have all gotten to the point we understand, let's keep the curve below the capacity in hospitals. Much the same is true in climate. If we get above a certain level, all of a sudden there are much larger effects that we actually don't control. We sort of always have this image that we're always in control. What we've realized is we're actually in control in a narrow band of reality. And if we break outside of that narrow band, whether it's in the financial markets or the oil markets or in climate, all of a sudden we are not in control in the way that we thought we could. And the cost of remediation after we lose control is way higher than the cost of prevention today. I mean, we did a look at just the utilities in the US, and you look at storm damage, and it is far cheaper to invest in preventative measures against hurricanes and flooding than it is to repair it after it's done. And yet there's a tendency to underinvest in resilience across the economy. And I think one of the big lessons learned is how do we've fine-tuned this, and Kathleen was talking about this earlier, we fine-tuned this so much for efficiency, but we actually need resilience much more than we give credit for in the physical system and in the economic system. And so, again, we have a real opportunity as we come out. One of the amazing things is, we are going to be at a point where carbon emissions in the US may be as much as 20% down this year because of the economic challenge. And so then the question is, as we come back, what assets do we bring back? And how do we think about what that rebuild, can we rebuild better than in fact when we went down. And I think that's the opportunity.
I hope that people can be as rational as that. But, and I know this is not about healthcare, but healthcare is a great example where it's always cheaper to treat people before they get to the emergency room. Business has been arguing that, and yet we cannot get to a universal health system that would be cheaper for everybody if everyone were in it. So I worry that people's short-term economic interests cloud the longer-term viability for all of us.
About half of Americans are invested in the stock market, which has become exceptionally volatile with the pandemic. How are universities, pension funds, and other asset managers overseeing trillions of dollars of investments? Can they help finance the transition to a green economy? Today we have 4 experts to help us learn more. Brian Deese is Global Head of Sustainable Investing at BlackRock, the world's largest asset manager. He served in the White House as Senior Advisor to President Obama and is Acting Director of the Office of Management and Budget. Lori Keith is a portfolio manager with Parnassus Investments, a leader in the field of investing in companies that consider social and financial results. Pratima Rangarajan is CEO of the Oil and Gas Climate Initiative, an investment fund backed by some of the world's largest oil companies, including BP, Chevron, ExxonMobil, and importantly, state-owned oil companies of Brazil and China. She previously worked on wind energy for Vestas, the world's largest wind energy company. Ann Simpson is Director of Board Governance and Strategy at CalPERS, the California Public Employees Retirement System, the largest pension fund in the United States with more than $300 billion in assets. She's co-author of the new book, The Financial Ecosystem, The Role of Finance in Achieving Sustainability. Ann Simpson, I'd like to begin with you. CalPERS has been working on climate for a long time. How is this dramatic drop in the stock market? Oil is now at the lowest point it's been in a very long time. It's tickling $20, which is done a couple of times in the last 50 years. How is that affecting the transition away from fossil fuels when fossil fuels are so cheap right now?
Well, thank you very much for having us. CalPERS views climate change as a systemic risk. In other words, something which is going to affect all of our asset classes and all of our investments globally. And the key to addressing that is bringing down the emissions that are causing global warming. So regardless of, the turbulence in the markets at the moment because of the pandemic, which have the cruel irony of actually brought emissions down, so it really shows what can happen when you throw the off switch. We are absolutely focused on the need for this transition so that we get global warming under control. If we don't do that, we're going to be facing a wave of climate emergencies, which are going to require a similar level of response. And the longer we leave it, the more difficult it is. In other words, what we say is, there's a stopping distance here. It's easier to slow down when you can do it reasonably safely than having to slam on the brakes right before you go over a cliff. So, our view of this is the way we need to work. Our theory of change, if you like, is that investors like CalPERS, we are the owners, the co-owners of the companies that are producing these emissions. And our role as fiduciaries, that means we have responsibilities. It's a fancy word for what you need to do when you're looking after someone else's money. Our fiduciary responsibility is to make sure we've got the safety and soundness in this portfolio. So we require these companies to bring their emissions down, typically be about 80 to 90%, so that the biggest emitters in the global economy have got to what's called net zero by 2050.
Brian Deese, has the coronavirus crisis changed attention away from the longer, seemingly less acute or urgent climate situation for investors? Are they mainly because the market drop is so dramatic? Has it taken attention away from climate?
Climate risk is investment risk. And more generally, that we were on the front edge of a larger decadal structural shift in investor preferences that really changes and upends a lot of how traditional financial models and traditional financial analysis assesses sustainability risk. Our perspective at BlackRock has been that integrating sustainability into portfolios builds a component of resilience. which means that you should see better performance in risk-off environments. Well, we have a unique and unprecedented moment here, and what we've seen is if you look at benchmarks, 24 of 26 of the major ESG benchmarks have outperformed their parent traditional market cap benchmark. If you look at our portfolios, the sustainability integrated portfolios have really held up quite impressively during this crisis. And then the other element is around, there's been this sense of if there was a severe market downturn, would investors run away from sustainability because they have to focus on other things? And if you look at flows into sustainable strategies, in fact, in the first quarter, you saw record flows and flows uncorrelated with the kind of flight to safety and outflows in other market categories.
Lori Keith, your firm Parnassus has been devoted to that idea that Brian just mentioned, that sort of being good corporate citizens actually drives excellent or perhaps superior financial results. Your take on how this downturn in the market is affecting the turn toward cleaner energy? Is it helping or hurting, or too early to tell?
We think there's a very structural shift. We're in an era of decarbonization right now, and we think this is a multi-decade trend as companies continue to decarbonize. And we think certainly, there's going to be, in this immediate environment, there may be a bit of a slowdown. Certainly, we're seeing some disruptions right now, for instance, in supply chains for solar panels. Also, in terms of implementation of those panels, right? Obviously, with everyone shelter in place right now, there will be some temporary delays, but that by no means impacts the long-term strategy. When we look at the significant risk for environmental climate change risk, we think companies, certainly at the state level, are taking very much a proactive role in pushing forward renewable standards. We're starting to see that broadly across many states, and certainly in Europe, they've really been on the forefront of this. So nothing really derails that story. And for us as investors, it's really been a source of alpha to find and invest in a collection of companies that are really best in class around managing their environmental, social, and certainly their governance factors.
And alpha being additional return above additional risk. Is that
correct? That is correct. Yes.
Pratima, I want to ask you, the whole divestment conversation focuses on publicly traded oil companies. People who know the markets deeply, most of the hydrocarbon reserves are actually held by state-owned oil companies that shareholders' divestment can't get at, China, Saudi Arabia, et cetera. So actually, you have a window into that world because a couple of state-owned or semi-state-owned oil companies from Brazil and China are involved in your work. So tell us what window you have into the big part of the oil market that is not talked about in this whole divestment conversation.
That's absolutely right, Greg. I think divestment has done a good job in raising public awareness about climate challenge, and that is important. But in terms of actual climate impact, we don't really see it on the emissions. And that's because it's not really effective. Divestment isn't such an effective tool where other forms of investment or other forms of capital are available. It's not a great tool when you think about nationally driven, as you said, oil companies, which is where a lot of this is. And it looks at all fossil fuels as the same. Whereas when we need to solve real problems, we have to be contextual. And we have to look at what countries, what regions are capable of, and what they need as well. A one-size-fits-all approach is great on paper, but in reality, one cannot use the same approach in Europe and in Africa. In Africa, 57% of the population doesn't even have access to basic forms of energy. It just isn't the same story. We cannot forget people in this. It has to be an equitable and a just transition. It cannot just be financial. So, and I think and if you look for something that's really a much stronger, potent tool in answering the climate challenge, absolutely agree with Brian. It is policy. Policy can drive us to scale a lot faster, and we can actually hit the carbon challenge in the time frame we have. And the first thing there is to put a value on carbon. In 2 centuries of economic history tell us that we will not change behaviors unless we value what we are talking about, and we need a value on carbon. That's just plain and simple.
I'd like to go to our lightning round and ask some true or false questions for our guests, beginning with Lori Keith. In February, Harvard faculty overwhelmingly voted in support of a call for the university's $40 billion endowment to divest its fossil fuel holdings. As a graduate of Harvard Business School, do you agree or disagree with Harvard faculty?
True, agree.
Ann Simpson, true or false, divestment from fossil fuels is a feel-good gesture that has zero financial impact on the targeted company.
Oh, you said it.
So that's a yes. Lori,
Do you want to look good, or do you want to roll your sleeves up and get involved in this messy business of change? I do want, for the record, though, to say that CalPERS several years ago did sell its holdings in companies with a majority of revenues from thermal coal. However, that was after an engagement process in which we, decided to keep several, which were involved in the transition, but the others, we didn't see the transition opportunity. So just, investment decisions have to be kept under close attention. Thank you.
Thermal coal is kind of easy to get out of. Once an industry is kind of dying, then a lot of people head for the doors. Pratima, true or false, battery storage is hot and sexy.
Absolutely.
True or false, Ann Simpson, picking individual stocks is a fool's errand.
Well, a fool and his money are soon parted, as has been said. Stock pickers have not been able to beat the market, and at our size, when you're our size, you cannot, like a small investor, construct an active portfolio. No, it's a fool's game. Agreed.
True or false, Brian Deese, markets move faster than government, so there's no need for policy to drive a faster transition to cleaner energy.
False.
True or false, Pratima, mining lithium for batteries is a clean and sustainable enterprise.
It can be, but what lessons have we learned from history? Let's make sure that BlackRock and CalPERS are keeping all the miners clean and making sure that they are doing this in a sustainable way for the future.
True or false, Brian Deese, pension funds have return targets that are highly unrealistic.
I think there's a spectrum of pension funds, spectrum of return targets, and some of them are unrealistic and some of them are probably overly conservative.
True or false for Pratima, wind and solar energy can power cement and steel factories more cleanly.
They can power a lot of the auxiliary systems in cement and steel factories, but still in the kilns, the actual heating mechanism requires very high temperature thermal energy. So there's a nuanced answer, yes.
Yeah, wind and solar can't quite get there. So wind and solar can't power, some really heavy industry. All righty, thank you for getting through the lightning round. One of the more memorable and fun parts of Climate One podcasts of this and other Climate One shows are available wherever you get your pods. Please help us get us more people talking about climate by giving us a rating or review. It really does help. Thanks for joining us online for this live stream. Thank you for your questions. We'll see you next time, everybody.